George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors, joins us today to talk about his outlook on gold, ETF flows, and asset allocation. Everything a gold investor really needs to know. In one-stop shop, George, welcome back to Kitco.
Thank you, David. Nice to be with you.
We're going to start with your macroeconomic outlook on the gold price, and then we'll continue from there. So given everything that's happened in 2020 and given everything that you think will happen in 2021, how do you like gold?
I like gold long-term very much. I think that short-term, there are a couple of bumps in the road, but I don't think that they're going to remain bumps in the road for very long. I think that once we got clarity on the results of the US presidential election, with President Trump now starting the transition process, it all seems fairly clear. We still have to wait for the outcome of the Senate races, the runoffs in Georgia in January, but it looks like we're going to have divided control, with the Republicans holding on to the Senate, the Democrats holding on to the House, and of course taking the White House. So that element of uncertainty as to what was going to happen politically in the US has been removed from the equation, and that was one of the reasons why people had been buying gold as a potential defensive asset in the face of political uncertainty. So one aspect of that uncertainty has been removed. We still don't know exactly what's going to happen. Are the Republicans definitely going to keep control? They need to win both of those races in Georgia in order to keep control of the Senate. And what kind of a Senate will it be? Will it be obstructionist, as it was frequently under President Obama? Will it be accommodative, as it's been over the last 4 years under President Trump? We simply don't know the answers to these. So those broader uncertainties are still with us. What we've seen as a result of the resolution of the election is some speculative long liquidation in GLD, some speculative short selling in the gold market at large. I don't believe that that's going to last very long. I'm looking for a recovery toward the end of this year, and certainly as we go into next year. And then if we look into next year, there are all the other uncertainties that drove the gold price to a new all-time high in the first week of August. All those other uncertainties are still with us. Have we finally dealt with COVID-19? What is going to be the impact of vaccines? How widespread are they going to be? And how quickly are we going to reach herd immunity? There are suggestions. Moody's Analytics is suggesting that maybe the economy is weakening again. They're even pointing to the possibility of a double-dip recession. That would probably be bad for the stock market. And again, people would be looking for defensive assets. Gold has proven a pretty good defense against stock market weakness. So I think that's going to be one of the major drivers, those uncertainties that are still with us going through 2021.
You mentioned speculative short trading. Now, I'm just putting myself in the shoes of a trader right now, and I'm trying to give myself a rationale as to why I would be shorting gold, or why I have been shorting gold in the last few weeks to months, and I really can't think of any reasons. Can you help me out here?
Yeah, sure. I think that before the election, we found that there were a number of investors, a number of speculators especially, were very concerned about the possibility of the blue wave, the Democrat trifecta taking the presidency, the Senate, and the House of Representatives. That was what all the polls were telling us up until the beginning of November. That was an area of concern for a lot of people. They feared a radical left-wing agenda, socialism, if you like, which is such an evil word in U.S. politics. So a lot of people had gone short the stock market and gone long gold, expecting the stock market to go down if that blue wave came in, and expecting gold to go up. The results of the election are that we probably do not have the blue wave. The Republicans are now likely to keep control of the Senate. So that concern has been removed. So people removed their short positions in stocks and went long, which is why we saw the indices move up to all-time highs yesterday. And they liquidated some of their long positions in gold. Some of them even went short gold, because they felt that people would not be looking to gold as a defensive asset because we don't get the blue wave. I think that is an excessive focus on just that one area of uncertainty, the outlook for the presidential election in the US. And I think that there are all of those other areas of uncertainty the continued ravages on our economy of COVID-19, plus political uncertainties around the world. How's the new president going to come to terms with Iran and with Korea? How is he going to deal with China, with tariff wars? All of these other things, I think, are still areas of concern. So I would think that the shorts are probably getting out ahead of themselves, but that is the way that traders tend to be. They want to be either long or short, and at the moment, they're seeing the short side as being attractive.
So here's a case I want to present to you, George. Should Biden seek to ameliorate relationships with the Chinese, that may swing the balance of trade in the Chinese's favor, because with the reversal of the trade wars and the removal of the tariffs, there may be more demand for Chinese goods and more demand for the yuan, and that might put weakness on the U.S. dollar.
I think dollar depreciation is inevitable for a whole raft of reasons, not just the likelihood of resolving our issues with China. China, if you look at it, China's moving on its own anyway with its Pan-Pacific Agreement that it negotiated just a few days ago. They were already starting to take their own way, irrespective of what's going to happen in U.S.-Sino relations. I believe that Joe Biden will probably move to improve those relations, remove some of the tariffs. Yes, that would mean a strengthening in the Chinese currency, and pari passu, a weakening in the dollar. So that is one reason to expect dollar depreciation, which historically has always been good for gold prices. But there's a whole bunch of other reasons to expect dollar depreciation as well. One of those is the ambitious programs that the Biden-Harris ticket was elected on, promising to tackle COVID-19 effectively, promising to expand healthcare reform in this country, promising to try to remove some of the inequalities of wealth and race in this country, infrastructure spending. All of these things are likely to prove expensive. That means the probability of bigger deficits, even bigger than we already have, and that means further dollar depreciation, along with improving relations with China.
Okay, George, so we talked about a bull case for gold in terms of seeing a weakness in the dollar. Let's talk about inflation now. Let me present to you a bear case. Now, my case here is that we're not going to see inflation anytime soon. In fact, we're still very much in a deflationary environment. As you know, there is a positive correlation between inflation and gold. As businesses still struggle to recover, as more economists are expecting even more bankruptcies into 2021, I'm looking at the M2 money velocity, and it's still very low. I'm not seeing strong indicators of recovering inflationary prices in the U.S. And so that's not going to provide a lot of tailwinds for gold in the first half of the year. What do you think?
I'm completely in agreement with you on the issue of inflation, David. I'm not seeing inflation in the United States until our economy is humming along on all cylinders again. That will generate the velocity and the movements of money around the market, which we haven't seen for many, many years now. So I'm not seeing inflation until probably well into 2021, if we're lucky and we're able to get our economy back on its feet by then. And I'm, as you know, longer term, still worried about the outlook for the US economy. But gold doesn't need inflation to go higher. If you look back to the beginning of this century, just to the year 2001, let's take that, gold was at $250 an ounce. Today, it's over $1,800 an ounce, and we have not had a lick of inflation in that 20-year period. Gold does not need inflation to go higher. There are many, many other drivers behind the price. It's not just an inflation hedge. It has many, many other properties that investors clearly want, which is why they've driven the price as high as they have. So we don't need to worry about inflation. I still think we've had massive money creation, but the other half of Milton Friedman's recipe, as you rightly say, is the velocity with which that money moves around in the market. We won't see that until the economy's back on its feet.
Okay. George, if you think that gold is not an inflation hedge, then what is the primary role of gold for an investor? Or maybe it's an asset that wears many hats, and depending on the times and the macroeconomic conditions, maybe it'll switch roles. What do you think?
I think gold is still a very good inflation hedge, but we just don't have any inflation.
Okay.
So right now you don't need an inflation hedge. But I think what gold is also doing, I think that since the global financial crisis of 2008, I think that gold in many ways has taken on the role that we always used to look to the fixed income markets to deal with, which is to be a defense against potential weakness in the equity market. What we've seen since 2008 is that equities and bonds frequently move together rather than moving in the opposite direction. But gold and the equity market typically tend to move very much in the opposite direction. When equities are weak, gold tends to be strong. When equities are strong, gold can go up, down, or sideways. It's done all three since the global financial crisis. But every time equities have been weak, then gold has tended to be strong. And I think that that is a very important role for gold going forward. That is one of the roles, in addition to being an inflation hedge whenever we have inflation. And the other thing about deflation, the most important work I know on the relationship between gold and inflation was Professor Roy Jastrom's book, The Golden Constant. Written in 1970. There's an update to that book available from the World Gold Council, which includes the original Jastrom book, which had gone out of print, and brings the analysis up to date from 1970 all the way up to 2010. And Jastrom's analysis went back to the 14th century in the UK and the 18th century in the US. What he said was gold is a good protector against inflation as long as it's high and sustained, and by that he defined as more than 3 months at over 3% a year, which we've not seen in a very long period of time. But he said also counterintuitively, during periods of deflation, over that 600-year period in the UK, during periods of deflation, gold tended to lose value less rapidly than all the other assets. So it's actually good in inflation and it's good in deflation as well. The only thing gold doesn't like is a gradual reduction in the inflation rate or disinflation.
Following that logic, George, wouldn't you naturally see huge inflows of gold in countries such as Venezuela, Lebanon, Turkey, Zimbabwe, countries with very high month-over-month inflation rates? Are we seeing a lot of gold flowing into those places?
No, because I think that because of the economic problems besetting those poor countries that you've mentioned, people simply don't have the cash available. They're using whatever cash they have available to buy things like bread and shelter for their families, rather than being able to invest in gold. So we're not seeing floods there, no.
So it is ironic how gold is meant to protect against such levels of borderline hyperinflation. Yet when that besets the society, that particular society might not be able to afford inflation protection.
David, I think the issue there is, and you really put your finger on it, people should always have some gold at hand ahead of any potential need to use it. You don't wait until your kitchen's on fire before you ring up the insurance company and set up your homeowner's insurance. You buy it well in advance. And I think that having some gold in a portfolio as a long-term strategic asset makes an enormous amount of sense, so that in a crisis, you can potentially make use of it.
So then bringing it back home to the U.S. now, George, do you think our kitchen will be on fire in the next year or two? Do you see weakness in the equities markets, like you brought up as one of the factors of gold? Do you see inflation eventually picking up? Do you see these problems trickling in?
Yes, I do. I don't know that they're going to be as disastrous as they were in 2008. I don't know whether it's going to be as bad as it was in March of this year. But I think that the situation, the current economic environment right now, is set up to see a lot greater volatility across all financial markets. And that's going to be volatility sometimes upwards, as we saw yesterday in the stock market, but also sometimes downwards, as we saw in March of this year. I think we're going to see a lot more volatility, and gold has a track record as being a good protector against volatility in other financial markets. I think that that scenario is a definite.
I'd like to address the ETF inflows and outflows with the net flows. Over the last few months, the trend has been down, and the latest reading from the World Gold Council has been a very low number relative to previous months. Is this trend concerning to you?
It is concerning, but as I say, I think what it reflects is speculative long liquidation. In other words, gold is being shaken out of weak hands. And that means that what is left is in firm hands, people who've made a long-term strategic allocation. And I think that getting some of the speculative froth out of the market is a very, very healthy thing to do. If you look at flows year to date, inflows into gold-backed ETFs have been enormous year to date. With something like 20 billion going into GLD alone, the biggest gold ETF in the world, something like 20 billion net, in spite of the outflows that we've seen in the last few months. So I think it would be important to keep those flows in perspective. Year to date, we are still up massively. And similarly, the gold price has shown some signs of weakness lately, but year to date, we're still up almost 20%. That's a pretty damn good performance.
Are the flows from a month-to-month basis, are those a leading indicator for gold prices or a coincident indicator, you think?
I wish I knew the answer to that one. It's a question that people ask me all the time. I'm really not sure that I actually know the answer to that. I think that developments in ETF flows simply reflect developments in the gold market at large. And I think that most of the time, the gold market at large tends to be reacting to events in other markets or in politics, whatever it may be, rather than proactive. So I would tend to think that most of the time, they're a coincident rather than a leader. But every once in a while, you'll see a sudden move in one direction or another that probably has some potential to be a leading indicator, but mostly not.
Right. So lastly, let's talk about how to actually buy gold. There's several different instruments, as you're very well aware. The GLD, you've worked on the GLD when it was first launched. And so we've seen a huge influx of popularity amongst investors with gold-backed ETFs over the last decade and a half. Why is that? Why have funds been outperforming the bullion in terms of popularity? Because keep in mind, the counter argument here is that, well, why pay a management fee for these funds? Why not just buy physical?
Okay, first of all, the physical thing. Gold-backed ETFs are physical, but the physical is in the possession of the trustee rather than in the possession of the individual investor. But to look at GLD, for example, $78 billion worth of shares trading on the New York Stock Exchange, $78 billion worth of gold sitting in the vault. That's about as physical as you can get, unless you actually insist on having the gold in your own hands. So there's still a physical investment. As to why ETFs have been so popular, I think that they demonstrate one thing very, very clearly since we launched GLD 16 years ago in 2004. I think that they demonstrate that what most investors really wanted was not necessarily physical possession of their metal. What they wanted was exposure to movements in the gold price without the burdens, including costs, of actually owning the physical in their own possession. I think that, to me, is very clear. That's what GLD gives you. It gives you exposure to movements in the gold price, 100% minus the very, very small costs of administering the trust. As for paying a management fee, people who buy gold, physical gold, whether they buy coins or bars, typically will be paying a sizable premium upfront and potentially suffering a discount when they come to sell. Those premiums for some dealers can be as much as 5%. I think that you do not face a premium when you buy GLD. You will not face a discount when you sell it. What you're paying is essentially the 40 basis points a year management fee. That's a lot less than the kind of premium that you would be paying for physical gold. The other thing, the trust in GLD takes care of all of the custody arrangements, all of the insurance, whatever might be necessary to keep your gold safe. If you buy your own gold and take delivery, you're responsible for that. And that can be very, very expensive for an individual investor to do. GLD has the benefit of economies of scale, having this enormous quantity of gold. It's actually cheaper to store that than it would be for lots and lots of individual investors.
And what should be the appropriate asset allocation for gold?
We decided that nobody really has a 60-40 portfolio anymore. Everybody's got something beyond just stocks and bonds. They might have some commodity exposure for one vehicle or another. They probably have a little real estate, maybe some private equity, whatever. We took a fairly typical global multi-asset portfolio and plugged in various different quantities of gold into that portfolio, ran the analysis back to the time when we launched GLD, back at the end of 2004. And what we discovered was that various different allocations, we tried 2% gold, 5% gold, and 10% gold. And at various different allocations, we saw a small reduction in risk and a small increase in returns. That adds up to a better Sharpe ratio. What we discovered with that analysis, and this comes true every quarter when we have to update it, what we discovered was that the optimal allocation to gold seemed to be at the 10% level. And I think that is perfectly realistic. Now, a lot of people have been comfortable having a 5% allocation to gold in their portfolios for many years. But if you are comfortable at 5%, and if you're as worried about the outlook for the economy, potentially for the stock market, and the problems that we have politically around the world, then the 10% level is looking a lot more attractive right now.
Does $2,000, $2,100, which is close to what we saw in August, does that price make sense for 2021? Can we see a retracement back to that high?
I think that price makes a lot more sense in 2021 than it did in 2020. When we reached those levels in the first week of August, I think there was a lot of speculative froth in the market, and I'm happy to see that has now dissipated. I think that when we reach those levels again next year, that speculative froth will not be there. They will be genuine investment levels, and they will be sustainable. That's my suggestion.
Perfect. Thank you so much, George, for your time. I appreciate it.
David, thank you. A real pleasure to be with you.
Pleasure is all mine. David Lin reporting for Kitco News. Stay tuned for more.